Shan, as we know, Fed Reserve officials continue to see significant inflation risks that may require more rate hikes. And what is your opinion? Do you see that the Fed will still continue hawkish in the near future?
If you look at and analyze history, whenever elections are closer, Fed has paused. If you look at 2018, when the markets were bad, in 2019, Fed started cutting rates. So I don't foresee Fed raising rates from here, and they will continue to have a very dovish stance. And because of that, the market will stay uncertain and investors nervous. So I think the hawkish stance has really created shenanigans, and it has created a lot of bloodbath in the market. So that's why I think Fed will take a very cautious approach. The challenge right now is that Jerome Powell is following Paul Volcker's strategy of 1970s, late 70s, and early 80s. But right now, the market is having a different view, and market is following what Milton Friedman, one of the greatest Nobel laureates, said 33 years ago. I know the script. He said how Fed is going to create panic, and it will create inflation with the form of QE. And exactly it is happening right now. Fed is panicking. They have created inflation in the form of QE, and the markets are not settling down very soon. The ructions in the market are of a magnitude not seen in a generation. And the way the investors are analyzing the markets, the alchemy of markets have changed dramatically in the last 17 years. I have been following Fed since 2006. Fed has committed a lot of errors, and the monetary policy has worked in the lag. They are too much dependent on data. That's why Fed is losing control of market, and investors are getting nervous.
Okay, Mr. Shan, like as we know also, like Fitch rating warns of the possibility of the having to downgrade the credit ratings of the dozens of banks, including JP Morgan Chase. Before Fitch, Moody's also had already downgraded 10 U.S. banks, while placing other large institutions on a watch list for a potential downgrades. Do you think the impact on the U.S. economic will be as a result of this? Could the Fed increase the interest rate up to 50 BPS compared to previous prediction of only 25 BPS until the end of this year?
I think the call that the rating agencies have been making, they are also behind the curve. So I don't really follow what the rating agencies are saying. But most of the banks right now, they are in a very tough situation. We have seen the collapse of Silicon Valley Bank. We have seen the collapse of Credit Suisse. I have personally seen a financial history very closely in US when Lehman Brothers went down. 15 September 2008, Monday, I was in Chicago. When Bear Stearns went down, 18th March, Tuesday 2008, I was in Chicago. So I think banks are in a very tough situation. We might see, last week I was with Bloomberg Dubai, and I said, bond market is going to create shock in the financial markets. And look at the yields of bond market, they are going up. So I think if the yields continue to go up, because I follow the debt market, and the debt market yields, they give you a lot of forward guidance, what is coming in the market. And at the start of the program, you rightly pointed out, inflation will not come down. Inflation will stay elevated because oil prices are going up. Look at Europe, the gas prices are up 40%, and the oil prices are up almost 10% year to date. So I think inflation will stay high. Banks will have a very tough situation. If the Fed continues to raise by 25 to 50 basis points, bond prices will continue to stay low, and that will create a very tough situation for these banks. So it's a very complex situation we have not seen in financial history, but it will create a lot of challenges for the banks moving forward. So I have already shared with our valued and sophisticated investors, I don't see the global economy recovering before 2026, 2027. Inflation will stay higher till 2025 or even beyond. And most of these big four central banks like ECB, Fed, Bank of Japan, and Bank of England, they won't be able to control inflation.